just want to say first up that the strapline on the slide here is investing for generations. The first thing to say about Alliance Trusts is it's one of the larger trusts in the sector, and it's been around for a very long time. It's dating back to the 1800s and is very proud of its heritage of being able to compound shareholder wealth over very, very long periods of time. And that's very much core to what Alliance Trust really wants to achieve. It wants to be a core holding for investors and really be able to compound wealth over decades or generations. So it really is that sort of long-term investment mindset. Dan talked about the obsession that people have with short-term performance, and that's a reality. It's a natural human behavior, but it's the long-term compounding of investment that counts, and that's what Alliance Trust is focused on. I'm going to tell you a little bit about Willis Towers Watson, who we are and what we do. There's a slide come up. So you may or may not have heard of Willis Towers Watson. We're a very large global investment services firm. We typically work with institutional clients. We've also been around a very long time. We've been working with institutional investors such as pension funds, sovereign wealth funds, endowments, foundations, and the like. And we've been providing investment advice and investment services to sophisticated investors around the world. Increasingly nowadays, as markets and investing has become more complex, investors are looking for more help from us and from other providers. So today, we actually manage about $185 billion of assets on behalf of those clients, implementing the investment solutions to help them compound their wealth over very long periods. So the conversation with Alliance Trust started several years ago. We were appointed as the manager of Alliance Trust back in April 2017. And the conversation really started because Alliance Trust was looking for a differentiated offering to bring to the UK retail market. It wants to focus on global active equities, as Dan described. We're an actively managed portfolio fund, but they wanted to bring something different, like I said, and we felt that we could bring some of our expertise and some of the things we were doing in the institutional space to the UK market that would be of interest to investors over here. So the next slide is going to talk about the main pillars of the strategy which we use to invest in global equities. Dan described sort of the breadth and complexity, if you like, but also the vast opportunity that global equities can offer. So our strategy is called diversified high conviction, and I'm going to explain what we mean by that. But first of all, it's worth noting that, as Dan said, everyone's looking for, what do I do this year? Do I need to switch from growth stocks into value stocks? Or do I need to come from the UK? Do I need to buy the US? Do I buy Germany? Everyone's trying to make these sort of top-down allocation decisions. The unfortunate reality when it comes to active management is, as we all probably know, active managers, on average, the vast number of active managers, on average, don't outperform net of their costs. There's an unfortunate reality, but not everyone can be above average. It's just not possible. So if you're going to have an actively managed approach, you need to understand, what skill does the manager have, and how is that skill going to achieve added value net of fees? Now, our approach focuses on stock specifics. The skill set which we think investors really have is being able to analyze a business, understand that company, its competitive advantages, and its ability to outcompete its competition over the long run, and be able to value that business through time. So if stock selection is the skill that managers actually have, our approach is to maximize the skill that we're getting from that manager. So when we select managers, we don't just take the products which they like to sell to us. We customize portfolios. We ask managers to focus on a maximum of only 20 stocks, because that's how we get the best out of their stock picking skill. We don't want their 30th or 50th or 100th best idea. We just want to focus on the top 20 very best ideas they have. And that strategy means they're able to maximize the skill and therefore the long-term returns that they can offer. Key issue, of course, is a concentrated portfolio can be very volatile in the short term. And if you think back to Alliance Trust wanting to be a core holding that can compound wealth over decades and generations, that's really difficult if it's very volatile. We're all human. It's quite difficult to own things that are very volatile in the short term. So our strategy is to have many managers running concentrated portfolios. We've got about 10 stock pickers typically in the portfolio. And by doing that, we're able to select managers that have very different ways of thinking about how to invest money in equity markets. They've got different philosophies, different processes, and they're finding different opportunities from all around the world. And that's key, because that gives diversity and it gives resilience to your portfolio. And it gives you a wide breadth of different investment ideas. And that's how we get this approach of diversity. We've got about 200 stocks in the portfolio typically, but high conviction, because every single one of those companies is one of our stock pickers' very highest conviction investment ideas. So we think that's a pretty different way of building a global equity portfolio, focused on stock selection, but with the right amount of diversity to capture all the different ideas that are on offer in the marketplace. The third pillar is exclusive access. Some of the managers in the portfolio you may have heard of. I imagine there's a few in the portfolio that you haven't heard of and are not able to access as a UK equity investor. So, that's part of the Willis Towers Watson, positives of our global network and being able to bring sort of interesting managers that you haven't seen before to the market. And even the managers that you might know, you won't be able to access their customized, very concentrated portfolios, except through Alliance Trust. So again, bringing exclusive access to different idea generators. The fourth pillar, Alliance Trust, has paid a rising dividend every year. So the dividend's gone up in size every year for the last 55 years. Again, that's a heritage that Alliance Trust is very proud of, and the board is firmly committed to continuing going forward. So we know that we want to deliver long-term total returns, but investors have appreciated the rising dividend. Come what may with the vagaries of equity markets, that dividend has gone up every year for 55 years. Sustainability. This is another important pillar. It's a topic which is talked about at great length today in markets and in press and everywhere else, frankly. There's a lot of confusion. There's a lot of discussion around what do people mean by certain things. For us, this is quite simple. We're selecting companies for our shareholders to own. Those companies are exposed to lots of different risks, including ESG risks and other sustainability risks. You cannot ignore these things. You have to assess what these risks are, because the world changes, society changes, things like climate change are having impacts on the world. These things are going to change preferences for your goods and services. They're going to change the costs associated with doing business. They're going to change your bottom line or profitability. So you have to understand these risks when valuing companies. So that's firmly integrated into everything that we do, from the stock pickers selecting their stocks and us analyzing the stock pickers and understanding who is skilled at doing this. The final pillar is low cost. So again, the whole purpose of Alliance Trust is bring a differentiated approach, something which is designed to be a best-in-class offering that can be a diverse strategy that investors can own for a long period of time. But to do all of that at a cost which is very reasonable and not too excessive, because the one pitfall of many of these strategies is to over-diversify or diversify, as some people call it. Create something which actually looks a lot like the index, but ends up being very expensive. Alliance Trust is designed to be the opposite of that. It's a high conviction portfolio designed to maximize long-term total returns and delivered at a cost which we think at 0.6% of the ongoing charges ratio last year, at or below what you might typically pay for any normal global active equity portfolio. So that's the overall proposition and the way we run money at Alliance Trust. Just to go into a little bit more detail on a couple of the points. This slide here is it's designed to talk about why do we do this customized, concentrated portfolio, this approach to stock picking. And really it's based on our own experience. We've been, as I said, working with investors all around the world for a long time. We worked with a particular charitable foundation who had this approach to concentrated portfolios. We've been working with them for more than 10 years on this approach to investing. So we've seen the benefits of it through time. But there's also a ton of academic evidence out there as well. I mean, this chart is just one chart I lifted out of many papers that are written about this type of effect. And what the research really says is that, whilst we know that most managers underperform net of fees, to actually maximize your chances of outperforming net of fees, it's those strategies that have higher concentration or higher amounts of active money. The more active strategies are better able to overcome costs. So this is not dramatically new. I think the industry has learned this in the last 10 or 20 years, and we have seen increasing concentration in active global equities, for example. But your typical global fund might have, say, 50 stocks in it. What we're doing by customizing and focusing on those top 20 ideas is really just pushing people to the right-hand side of this chart. So this chart is showing active risk along the horizontal axis there, with low risk on the left, high risk on the right. And then it's showing returns on the vertical axis. So as we move people to the right-hand side of this chart, we're increasing the stock-specific risk, and we're maximizing the potential of that skill to deliver returns to you as a shareholder. So that's why we have these customized portfolios. And the next slide, of course, comes back to this point that having just one of these is actually quite difficult for investors to handle. So actually having a multi-manager portfolio is really the best way of delivering this type of strategy. So this is the portfolio at the end of February that Alliance Trust has. You can see a range of managers. So Willis Towers Watson is selecting these managers, and then we're also deciding how much capital in the portfolio to allocate to each of them. So as the world changes and as things evolve, we will adjust the portfolio. We'll change these allocations through time to make sure that the total portfolio has the right risk characteristics and the right diversity and structure. And every so often, of course, we might need to change a manager. And that's the beauty of having this kind of structure. It means as a shareholder, you know that you've got a variety of different managers giving you lots of different ideas from around the world. You don't have to chop and change things yourself. And Willis Towers Watson is evolving that portfolio to make sure that it maintains sort of the best-in-class stock picking approach that we've talked about. Just to give you a really quick idea, if you take, for example, Sustainable Growth Advisors, which is about 8 o'clock in this pie chart here, the clue is in the name. So Sustainable Growth Advisors are looking for companies that can sustain high levels of growth for long periods of time. They might be well known. A company like Visa is a good example. This company has been able to compound its high level of growth over long periods and has been a great investment. And if you contrast that with someone like a Lyrical Partners next to SGA, Lyrical is completely different. They're looking for deeply discounted companies, companies that are very cheap. So they're looking at the bottom decile of valuations across the market. But out of that pool of cheap stocks, they're trying to pick companies that are actually good quality, can grow their earnings and profitability, but have just been misunderstood by the market and are too cheap. So it gives you very contrasting ideas. SGA finding good quality companies that are firing on all cylinders, compounding growth at really high rates. Lyrical finding obscure, undervalued companies that the market has misunderstood. And that's the kind of diversity that we're getting in the portfolio. And that's why, no matter what sort of market regime we get, and when the world switches from growth being in favor to value being in favor, our portfolio is always going to have stock ideas that are doing well over that period of time. People always ask about performance, so we've got a lot of numbers on this page. I'm going to focus on the right-hand column, which is the performance since we took over running the Alliance Trust in April 2017. So you've got total shareholder return at the top, 9.1% per annum. You've got the NAV return of 9.2, and we've got this NAV excluding non-core assets at 9.5% per annum. So NAV excluding non-core basically means when we took over the trust, about 10% of the assets were in sort of non-global equities, other things like private equity and mineral rights and other things. Those were gradually sold off over the next 2 or 3 years. So if you want to understand how the equity portfolio is doing, the NAV ex non-core at 9.5% per annum gives you the best idea. That's a pretty strong return. I mean, Dan talked in his presentation about you might expect sort of 6 to 8% per annum from equity markets generally. So we all know that equities have been doing very well recently, despite some of the challenging real-world backdrops that we've had. So good, strong, absolute returns, compounding that wealth over long periods of time, like we talked about. Then we show the Msci ACWI benchmark, which is one of the benchmarks that Dan was illustrating earlier on. That benchmark 9.8% per annum, so a little bit ahead of Alliance Trust. So clearly we expect to be ahead of the ACWI over very long periods of time. We think we can outperform it by maybe 2% per annum in the very long term. So we haven't done that in the last few years. And of course, the immediate question is why? What's going on? And the simplest way I can explain this, given the time we have, is with hindsight, I think everyone's very comfortable on a going forward basis that you don't put all your eggs in one basket, particularly if you're trying to manage your own sort of lifetime savings, for example, or your retirement wealth. So people diversify. They have equities and bonds. They have various different funds. So I think this idea of diversity is sort of well understood. In the last 5 years, actually, what you really wanted to do was put all of your eggs in one basket. Dan showed the stats. The US equity market has outperformed everything else by a very big margin, and some of those US tech stocks have done incredibly well. So really, you need to put all of your money into US tech. Now, our approach, like I talked about, is have diversity, have lots of different ideas, lots of opportunities. That will do very well over the very long term. And like I said, we've been compounding very high rates of absolute return. And in the long run, we think we're going to outperform the equity market through good stock selection through time. It's just, it happens in the last few years where the market has focused very much on one particular thing, which is US large cap growth stocks. Just to give you an idea of what that means in practice, I'll just skip a couple of slides here. This is the fundamentals of the portfolio. So Dan was talking about where are we finding opportunities in the market today? Well, we find opportunities in a very bottom-up way. We're not trying to pick, should we buy UK or Europe? Should we buy energy versus tech? We're looking for company-specific opportunities, and across the world, you can find great businesses that have got better than average earnings, better than average quality of those earnings, and are cheaper than the market. So this is our portfolio overall. So Alliance Trust in purple versus the benchmark in sort of a green color. And you can see that fundamentally our portfolio looks really strong. And that's why we think our stock picking approach is going to compound capital well ahead of market over the very, very long term. I'm just going to jump back to a slide I skipped. So the last point was on the dividend. Again, when we think about opportunities, we're trying to deliver that long-term total return to investors. But that total return is made up of capital returns and of dividends. And the investment trust status that Alliance has means that it's able to increase its dividend and sort of deliver a higher level of dividend to investors through time. So that's what the board did last year. They increased the dividend fairly meaningfully, up about 30-odd%. And that really was because we've got a wide range of shareholders. And the view is that actually a lot of shareholders, whilst they like the total return and they like the increase in dividend, a lot of them would also appreciate a higher level of income. So Alliance Trust has been able to raise that dividend, which hopefully is going to make the trust more attractive to a number of different investors, but is also fully committed to ensuring that that dividend keeps on growing year on year like it has done for the last 55 years. So no change in strategy, no change in everything that we've just been talking about, but a higher level of dividend being paid by the company. So that's essentially my presentation. So thank you for listening. I understand that we'll be back for questions later on. So hopefully you've got a good idea of how we go about sort of concentrated stock picking approach to finding opportunities in global markets. And I'll look forward to taking your questions in 20 minutes time.